8 days. That's all it took for one of the most consequential Nasdaq rule changes in years to go from approve to pause. In just 8 days, the SEC approved the rule that many people fundamentally believed would reshape Nasdaq's continued listing standards. And almost overnight, boards started scheduling emergency meetings and calling their lawyers and calling their investment bankers and really trying to come up with financing alternatives. And everybody was really asking the same question: what's next? And then everything changed, not because the rules were overturned or the commission changed its mind, but because the procedural rule that almost nobody was talking about suddenly became the biggest story in the emerging growth markets. So today I want to walk you through exactly what happened over those 8 days, why it happened, and why every Nasdaq company should still be paying very close attention. Have you ever wondered what's really happening inside the emerging growth markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Emerging Growth Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman, Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most ambitious and committed entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a real, clear-time view of what's happening inside the emerging growth markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference. Okay, welcome back, everybody. So as you probably noticed, today's episode is going to be a little bit different because every once in a while, something happens in the emerging growth space that really can't wait till the next scheduled episode date. And I really believe that today is one of those times. And if you've ever followed me on LinkedIn or on Substack or listened to this podcast or any of my recent interviews or keynote speeches, you've known that I've spent a lot of time speaking about this rule, speaking about the Nasdaq $5 million delisting rule, going down to Washington, serving on a committee, making a lot of noise about this stuff. And why do I do that? Well, because I really believe that this rule had the potential to fundamentally change the landscape for hundreds of emerging growth companies. And then on July 22nd, as I was coming back literally from Washington from my meeting with the Small Business Capital Formation Advisory Committee, the SEC approved it. And almost overnight, the entire conversation in the industry changed, and people stopped asking, is the rule going to get approved? And instead, they started almost frantically asking, what do we do now? And just over a week later, the entire story changed again. So today, I want to spend just a few minutes separating the headlines from the actual process and explain really what happened, why it happened, and most importantly, what it means and what boards and management teams should be doing right now. Because while the rule may temporarily be paused, that doesn't mean your company and your strategy should do the same. So before I tell you what happened, let me spend a minute on why this proposal become such a big deal. On the surface, the $5 million market value rule doesn't really sound all that dramatic, but this wasn't just another continued listing standard. It really did change what happened after a company fell below that threshold or fell below a listing requirement in a very different way. You see, because under the proposal, if a company's market value of listed securities, or just a fancy way of saying market cap, stayed below $5 million for 30 consecutive trading days, or roughly 45, calendar days, that the company would be subject to automatic suspension and delisting from Nasdaq. And that is an extreme measure to begin with. But here's what made this proposal extraordinarily different. You see, unlike many other deficiencies, in fact, almost every other deficiency, in this rule, there would be no opportunity to go before an independent hearing panel and explain why the company deserved more time or even have any right of appeal. Once those 30 trading days were up, this process became relatively automatic. And that's why the proposal generated so much attention. You see, NASDAQ really believed, and rightfully so, that this would improve the market quality and address some concerns involving lower price securities that may be subject to market manipulation. And there was a little China component in there too, which, respectfully, I had disagreed with. But whether you agree or not is really not the point. The point is that the impact for this rule reached far beyond the companies that people were talking about, because it ended up becoming, or would become, a self-fulfilling prophecy. Once you hit $30 million market cap, $20 million market cap, and down to 5, there's no right of appeal. And again, this wasn't really about China, although we've heard this many, many times. This was a rule that really affected tons of different companies, including from every sector: technology, biotech, industrial. I mean, real operating businesses in our emerging growth world with real employees and real products and real shareholders trying to survive in arguably one of the toughest financing environments we've seen in years because of some of the new rules that NASDAQ passed. And based on our own analysis, roughly 200 companies immediately would have been affected by this new rule out of the gate. And suddenly, everyone was talking only about one date, and that date was September 2nd, because that is the date that the first wave of companies would have been automatically delisted, because July 22nd was the date the rule was approved. July 23rd was one day. If you count 30 trading days, you get to September 2nd. That was D-Day. That was the day that almost 200 companies, maybe more by the time we got there, were going to be automatically delisted. And that would have been a terrible outcome for the emerging growth space. But that's really where the story begins, because remember, once the rule was approved, everything changed literally overnight. I mean, nobody was asking about whether the rule would pass anymore. Everybody was calling emergency meetings. Everybody was looking at financing alternatives and saying, what do we do now? I mean, I'm not exaggerating when I say I dealt with this question every single day, almost all day for the better part of 6 days on certain transactions, because everybody was nervous. Everybody was trying to figure out what to do next. So for about a week, everyone accepted this new reality that the SEC had approved this rule. And again, companies were preparing, and boards were planning, and investment bankers and lawyers were plotting. Then another question really started to float around the industry. And people started looking at this and said, wait a minute, is this approval actually final? And when I first heard about this, I was actually really curious. My phone started blowing up a little bit the day before this stay went into effect from some of my contacts in Washington and some other committee members. And then I started reading the rule. And then all of a sudden, I read a little bit more about this technical petition that was filed. And this issue really wasn't about the $5 million rule per se. It was about a technical exception. And it basically goes like this. Not every SEC rule is approved by the commissioners. Sometimes that authority is delegated to those inside the commission and lower level people. And that's exactly what happened here. You see, I've been practicing law for over 20 years, and I can tell you this isn't the type of procedural rule that comes up every day in practice. So it's very easy to overlook. But the Small Public Company Coalition, together with its counsel in Washington, filed what's called a notice of intention to petition for review. That's just a fancy way of saying they found their very, very clever provision in the code that allowed them to ask the commission itself, the commissioners, to review the approval of this order and not rely on the delegated authority. And apparently that is allowed to be done. and that caught everybody by surprise. So it automatically stayed this new rule for at least 7 days until the commission can look into it and figure it out. Again, of course, unless the commission objects or otherwise sort of overrules that. So think about it. The rule had been approved. Companies were basically scrambling and preparing. And then again, almost overnight, the implementation clock stopped, basically because of a procedural exception. Now, let me make what I think is probably the most important point of this entire episode, because I've seen people suggest in headlines and on LinkedIn and other places that the commission had concerns about the merits of this rule. And that is not what happened. This stay is purely procedural. It's how the SEC rules work. This petition is allowed under the rules, and it is perfectly fine, apparently, to ask the commission to review the rule instead of using its delegated authority. And the commission, again, did not say that this rule was bad or this rule was good. It's simply the process working exactly the way it was designed to work. And after the automatic stay took effect, the commission issued its own order, basically continuing the stay while it considers the petition for review. So again, I don't think we should read any more into it than what the order itself says, which basically says it's going to be paused until the commission can find some time to review about it. This had nothing to do with the merits. So anybody that suggests that it did or that it's been overruled, it's just simply not true. So where does that leave us right now? Well, it leaves us somewhere where very few people predicted just 8 days earlier. Again, because the rule had been approved, the order had been stayed, the implementation clock had been stopped, and all of that happened in really just an 8-day period. The way I look at it is it was 8 days of intense whiplash, and the story still isn't over yet. So what does that mean? The honest answer is nobody knows. And I don't say that because I'm trying to avoid the question. I honestly don't know. I say it because it's the truth. If the last 8 days have taught us anything, I think it's that the regulatory process doesn't always move the way people expect it to. And this petition for review that automatically triggered the stay under the SEC rules is a perfect example of how that procedural process plays out in real life. Now, will the commission review the petition or will they decide what happens next? Nobody knows. How long will that take? I'm not sure either. But here's what I can tell you. I can tell you that the pause is definitely in effect. I can tell you that there is definitely no set timetable. I can tell you that the last time this happened, according to our research, it took roughly about 6 months for the commission to act. And I only say this for historical context, not because I think it's going to happen here. Of course, they could move much faster and it could take much longer, or it will never resurface and could die in this procedural defect. Nobody really knows. But I say this because I want you to know how this happened, why this happened, and the truth. But here's my take. So again, over the last 8 days, we've had these crazy conversations going back and forth with everybody. And almost every one of those conversations ended the same way. What do we do? And my answer was always the same every single time. And that really was, just because there's a pause, it's not the end of the story. And the rule hasn't disappeared. It's just waiting. So if you're a board or you're a management team or you're running a company, I would still be vigilantly policing my market value listed securities every single day. I'd be watching my market cap. I would be tracking it and still finding financing ways, financing opportunities, strategic alternatives, communicating with investors, communicating with your shareholders, strengthening your balance sheet, whatever that is to ultimately increase the value of your company, because none of those things, in my view, depend on what the SEC ultimately decides. We should be doing anyway. And one of the things I've learned over the years is that great leaders, whether that's in the emerging growth space or great CEOs or maybe even athletes, they don't wait for certainty. They prepare while everyone else is waiting. And it reminds me of a book that I'm currently reading by Dan Hurley of the famous Hurley, basketball family, called Never Stop. It's just on the top of my mind today while I'm recording this. And I would encourage every CEO and director out there to really read it, because it's not really a book about basketball, although it is set in the basketball backdrop. So if that's not your sport, it's okay. It's really a book about leadership and about building a culture that refuses to become comfortable. And it's about continuing to improve when everyone else is taking a break or slowing down or making excuses. These high-level athletes and coaches and leaders, they keep working, they keep improving, they keep preparing. They basically never stop. And to me, that's exactly the mindset that I think public companies should have, not just right now, but all the time, but certainly right now in this period of uncertainty. The temporary stay shouldn't be a reason to take our collective feet off the gas, both for our companies individually and for the industry as a whole. If anything, it's an opportunity to really lean in and strengthen things that should be improved, like our balance sheet or our market capitalization. And I know it's not easy. I'm just making the point that if you can evaluate a strategic alternative or consider a potential merger, this stay has been a gift. Let's use this time wisely and ultimately move forward in a way that creates value instead of sitting around and waiting or hoping and then being surprised if the commission does put this rule back into effect. So never stop preparing. Finally, whether you supported this rule or not, or you opposed it, that really isn't the story that I was trying to tell today. The story really that I wanted to get across is what happened over the last 8 days and dispel some of those headlines that we probably have all been seeing that really aren't true. I think, again, this last 8 days reminded us that the regulatory process doesn't always move in a straight line, much like the emerging growth space. And these 8 days, certainly reminded me that procedure can matter sometimes just as much, if not more, than substance. And finally, I think it's all of our collective responsibility in the emerging growth space, and certainly responsibility for each and every company to continue to do the things that we should be doing every day, creating value, communicating with our shareholders, strengthening our balance sheets, and spending this time to better prepare our companies, build a better company, and do all those things that create value. Because regardless of how this process ends, those are the things that we will never regret doing. And maybe that's the biggest lesson from these last 8 days. Never stop preparing. Thanks for joining me on this special report of Inside the Emerging Growth Markets.
You've been listening to Inside the Emerging Growth Markets with Joseph Lucosky. For more insights from the trenches of the emerging growth markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@lucbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.